welcome to another episode of Epic Market Podcast. And this is this has been like a really good 2 weeks in terms of how the markets have functioned because it gives us a lot of stuff to talk about. Moise, if we can do this, if we can just recap the markets, just look at the charts a bit and see what's happening, how the markets have fared ever since New Year. What does it look like in the charts?
Okay, let's do it. So overall, the week we can analyze it by looking at the chart of the S&P 500. I'm going to look here at the SPY ETF. It gives me a good highlight as to what the market has been doing since the beginning of 2025. I'll start off just by highlighting the areas I want to point attention to just post December. So we're going to start here around January, coming into January 19th, which is today. So if we look right here, based on the daily chart, we've had quite a significant bullish run coming into just before October, towards the end of the year. Just a strong and healthy and expected what they call a Santa Claus rally going into December. The overall market, or at least the 500 stocks in the S&P 500, seems to have been showing bullish price action. We did get a short-term pullback, and closing in the rest of November into December, it's a strong move up. We actually made a high of about 607.03. But what I want to point attention to specifically here is in the past, let's say 19 days of the new year, the market overall, if you can see right here, has been struggling. So we had this sharp move up, we had a pullback, and it wasn't held. So it broke below this gray line, which is the 50 moving average. And since then, we've seen sort of lower highs, for example, right here, and even a lower low. Now, it seems like the market either might be doing one of the following three things. So either the market moves up, it takes a break by moving sideways, or it moves down, right? So we're looking at right now, and the market's taking a little bit of a break. And depending on how we open up and sustain the following week, closing the month of January 2025, it will indicate very clearly if the S&P 500 is leading into the new highs, breaking 607.03. But what we want to see here, and this is kind of touching up on the topic that we're going to sort of overview and kind of have an open discussion on, is that short-term volatility occurs in the markets. When you have a strong bullish run, you can't go forever, although we have seen that in a lot of individual stocks like Tesla, Nvidia. But once you see strong selling pressure, like you see here on this bearish red candle, it's a sign that profit taking could be happening. The market is a little bit less bullish than expected. We're seeing sellers come in, selling transactions happening. And overall, we're starting to see lower highs and even lower lows. But short-term volatility does exist. And depending on how this coming week ends the month of January 2025, will be a great determinant of whether we can continue higher, flatten out a little bit further, or maybe even move further down. But when you see short-term volatility in specifically S&P 500, or you're watching your individual stocks, just keep in mind that you should consider, and I consider this all the time, zooming out, right? So we're looking right now at the daily chart. But if you look at the weekly chart, it gives you a better indication as to what's really happening on the charts. So for example, going into this daily chart, it seemed like, okay, you know what, we're getting some bearish price action. But when we see a weekly candle like this right here, closing last week, almost the end of January 2025, this is a sign that buyers are standing up or stepping up again. And when we look comparing this red candle to this green candle, there are two important things that I want to highlight. Where the green candle opened and closed, and how much of the previous red candle it decided to overtake. This to me looks like buyers are back. We did get that short-term selling pressure, but when I'm looking at it from a technical analysis point of view, the market has held its 20 moving average on the weekly chart. And this extremely bullish candle taking over all of this red candle is a good indication as to the potential that if we open up above 597.58, 598, there's a very high likely chance that will continue higher going into the end of January 2025. But this is purely looking at the S&P 500 and just reflecting on, what's happened. It's been very choppy too. If you look at it, it's going down and then up and then down and then up and then making a lower low and then completely getting back up here. So if you're investing for the long term, it's always best for me to look at what I paid. I'm looking at a stock or an instrument that overall is healthy for the long term. So I can actually look at this moving average as a buying opportunity, because every time we came to this moving average, we went back up. Every time we came back to this blue moving average, we came back up. So the short-term volatility is definitely there. It's been kind of flat, but now looking at the weekly candle, we can see that buyers are very strong and they've clearly stepped up. Let's see what happens. Are we going to get moves that are going to go higher, stair-stepping further? Are we going to get more correction where the sellers are going to come in? Where are areas we want to look at seeing if there's potential buying opportunity? Throughout the last, I think, 100 years, we usually get about 50 pullbacks on the general market, and about 15% of those are about close to 20% or more. So those are generally seen as areas where there's a lot of fear. But those ones that are less than 20%, like the ones we see right here, they're also areas where you can look at buying and entering the market. And this is where I would look to buy the market. But right now, because in the last episode, we also discussed that it might be important to wait it out. You could even zoom even further out. Because in closing, I want to mention that when we had this COVID crash, we had a strong move, almost 300% higher. We pulled back into that previous area. And then we had another strong move, breaking and making new all-time highs. I would not be surprised still if this starts to making a downward stairway. And then you would want to look at areas around 480 to 500 to see where the S&P 500 might bounce and start transitioning upwards. So this is how I'm looking at the markets. I'm not too afraid of short-term volatility, but I also want to be concerned about the fact that if I decide to make any entry, it is higher risk for me to enter the market right now, and it might be wiser for me to wait for critical psychological levels around 500 to see where the market behaves. Because if we also look at it, one last thing here, we can see here from the very top, which is 607. Let me just remove that. Around 607, down to about $500, is that close to that 18% to 20% range. So I would not be surprised if I start to see more bearish sentiment. Maybe we enter sort of a short-term bearish market, but that all depends on how we end off this month, January 2025, and it also depends how we begin the rest of quarter one of 2025. So that's overall what the market has been doing, what I'm anticipating, how I'm observing the market. So back over to you, James, for your feedback.
Yeah,
on
it's been quite choppy. Was just following the markets. The first couple of weeks was down by a lot, and most of the stocks in my portfolio, like Nvidia being one of them, was completely butchered. There's so much more happening. And January is a really exciting time for a trader or even for a short-term investor, just because there's so many things happening that actually has its roots maybe in December, because there's this thing called the January effect. I don't know if you've heard of it. So a lot of stocks tend to move upwards in January, and this year it's not been the case. It's what's happening, right? the January effect, for those who don't know about it, it primarily plays out in like small cap stocks, but you could see effects of it like throughout the markets. The stocks tend to perform really well in January because of a variety of reasons, like psychological optimism being the primary kind of driver behind this, but also like tax loss harvesting. A lot of people sell stocks in December. They're sitting on cash that they want to deploy. Um, didn't really play out this January, but a lot of key data points to look out for in the coming few days. Obviously, tomorrow, um, the inauguration of the Trump presidency. 21st is the inflation data for Canada. And then the 29th is a really important date because of the interest rate decisions for both the Fed and the Bank of Canada. So, um, with how the inflation data has been going on for like the last couple of months, um, the view that, okay, 2025 is going to be a year of dramatic rate cuts, I don't think that's the case anymore. Obviously, there would be some rate cuts, in my opinion, but it would not be as aggressive. The Fed isn't looking to cut rates as aggressively as we were discussing about it in late October or November last year. Um, Again, was it like irrational exuberance? Like, what the market was overpriced in any case. The last couple of months, we have been discussing this in the podcast. Like, is it the right time? When is the right time? If not right now, I just came across this research in this article. I'll just share the screen. And this is this concept of mean reversion that I've been, obviously you know a lot more about it, Moise, than me, but it's a very important theme that plays out in various data points when we talk about technical indicators and stuff like that. But just as a overview, as of September 30th, the S&P 500 was trading 71% above its modern era historical trend value, which is about 2.0 standard deviations above, and is termed as strongly overvalued. I mean, this is as of September 30th. So here, if we plot out the data, like the closing data for the S&P 500 since 1950, and if you draw an exponential trend line, you'll see that the market was above the exponential trend line. But if we detrend that data, we'll see, and this is the exponential trend line just detrended in a way. And if you add the standard deviation lines on it, you'll see that around September 30th, it seriously went into the strongly overvalued segment, which is overbought. And we were expecting a downtrend from here. At least I was expecting a downtrend, and we have been discussing this in the last couple of sessions as well. But that didn't happen. Like, the markets, ever since the Trump victory, has just been rallying around. Okay, it's best for the stock markets to for Trump to be in power. How much of it is true and how much of it will actually materialize and play out, time would tell. But mean reversion says that it'll the prices, if they're up, they'll come back to the averages. If they're down, they'll bounce back up to the averages. What's your take on it? Like, is it something that day traders, I mean, obviously various indicators like the RSI actually talks about if a stock is overbought or oversold. Is it something that is this theory something that investors or traders should actively pursue, track, and invest time in?
Yeah, I believe so. It's interesting how you mentioned, for example, the relative strength index as well. I think it comes down to reversion to the mean is a real phenomenon, and it's from what I've learned about it. It has been applied to trading performance. So if you're a day-to-day trader and you have a strategy, you have some edge in the market, and you're executing trades, You may have some trades that take you way above, and you might be, experiencing euphoria. You're like, hey, I'm performing extremely well. But if there's something within those few trades that are not being pointed out, like you're not aware of the fact that, okay, these are outliers, you will end up getting back to your normal performance to some extent, because these type of overbought or oversold conditions don't last forever. And similarly, your performance is going to get back to some sort of baseline point. You're going to see your results get back to some sort of mean. And that's hence why reversion to the mean impacts traders, because they might have a hot streak, but if they're breaking their rules, if they're trading things that they're normally not trading, if they're getting lucky in the market, eventually the market's going to want that money back. So don't get too attached to it. And when it comes to technical analysis, how I've learned about reversion to the mean is simply the analogy of you're a marathon runner, okay? And you just ran a marathon. And then someone comes to you and says, hey, have a little glass of water and go for another marathon. You're going to look at this person and say, are you crazy? Like, I need to take a break. I need to rest. Stocks, the stock market, most, if not all, instruments behave the same way. They may have outliers where they're just going, they're breaking their highs. They're continuously going another 100%, 200%, whatever the move is. Eventually, it's going to have to take a break. And when it comes to the general market, from an investment standpoint, if you're the type of investor like me also who believes in buying index funds or the VTI, VTs of the Vanguard world, when you see those 50 corrections that happen in a 100-year lifespan, out of which 10 of them to 15 of them are going to be more than 20%, those are opportunities where you got to wait for and buy. And those are the areas where I look to buy. I firmly, like in past episodes I mentioned, I want to get the right entries. I want to add at the right time. And if we're looking at purely from the concept of reversion to the mean, the stock market will eventually have to take breaks. It cannot just keep going up, because there is short-term profit taking. There's balancing of portfolios. There's reallocation of funds. There's new entrants into the market. There are people that are exiting the market. There are people that have belief systems about the market that are changing. So the stock market does have this stair-stepping pattern. It is designed to go higher overall. If you're looking at a basket of stocks that are including the S&P 500, or if you're looking at VT, which is the total world stock market fund, that's been my experience. And I do expect, and I'm waiting patiently for the next 20% correction, even the 10% correction, because I know those are areas where I will feel less buyer's remorse if I add. And I'm just waiting, because when the market's continuously going up, and Bitcoin was continuously going up, for example, a lot of people bought it plus 100,000 USD, right? It's going to take a break. So it's better to do the opposite of that. You don't want to be in that cyclical alignment with the market. You want to be on the opposite side of that alignment. So when people are feeling very hot, the market's doing well, stocks are performing really well, the numbers are great, Trump's doing awesome, wait for it to come back. Once the bad news or the concerning news starts to kick in, people start to become more realistic about what's happening in the world. And then you see those corrections, and those are areas I would buy. And that's where reversion to the mean is. You're going to see that exponential curve line that you mentioned. Those are areas that technically are in alignment with the 20 moving average. If you look at the 20 moving average, it's also moving in that sort of exponential way. So you want to wait till the price action or the price of S&P 500 comes to that. That's been my experience, at least. Yeah.
I mean, how much of it is a function of, okay, because there's so many people tracking it, now the mean reversion theory actually exhibits itself in a more pronounced manner, because a lot of day traders, for example, use the RSI as a tool to at least screen stocks. Maybe investors per se who concern themselves more about fundamentals don't really care about, okay, if this is 10% higher than what I actually plan to buy it for, because I'm interested in the long-term run. How much of the mean reversion theory do you think, like, because of the reason that more people are now, looking at these indicators, the mean reversion theory actually exhibits it a lot more in a lot more pronounced manner than, let's say, 15 years or 20 years ago?
I think so. I think it's like a self-fulfilling prophecy that's just becoming. I think that this dissemination of information is at its all-time high so far, right? You don't need to wait even like a second to get the most up-to-date news, right? So information is being distributed very quickly, right? And the response time is a lot quicker now. Yeah. And I think it was one of these investors, hedge fund managers that I was watching, and they were analyzing in the past the reactionary time from a 20% correction, how quickly it got bought, right? So it was overbought. It decided to peak, and it came down, and maybe like 30, 40, 50 years ago, it would take some time for it to finally go back to the all-time highs. And then you look at COVID, how quick was that, right? So it is getting faster, but I think also now incorporating a little bit of like the Ray Dalio information we know about how market cycles occur over the 75-year period versus 15-year periods. I think that we're going to get closer to those macro corrections. And those macro corrections will have a bigger impact. The bearish market will click in and maybe take a little bit more time before it finds its bottom. And the recovery time would be a little bit longer. So maybe COVID can be kind of like a micro bearish trend, right? So absolutely, I think that the response times are getting quicker, but there is still a bigger picture at play because just because we haven't seen it, things are moving a lot faster right now, does not mean there could be an even bigger correction happening. There's no reason why a 20 plus correction cannot happen. But I think it's all like if you're overwhelmed, if I'm overwhelmed with not knowing when the right time is, the best way I can see it is once things are sort of cooled down after a big bearish market or a short-term bearish market, and you're starting to see things sort of calm down. And if you're looking at a line chart or a candlestick chart, you just want to see that you're seeing multiple bottoms being placed. You're not seeing new bottoms being placed. You're starting to see new highs being placed. And you don't have to be the first one. I'm never the first one in the market. I can sort of start building my position, taking a little bit of risk. If I want to buy, let's say 100 shares, I'm not going to go in with 75 shares right away. I might go in with 5, maybe 20, then 10, because then I'm less likely to feel buyer's remorse if I bought it at the wrong time. Because I find for me, specifically for day trading, I find that over hours and hours of videos that I've watched of my execution, I usually have a better opportunity to buy if I just wait a little bit longer. So if I take that 10-minute trade and make it into a 3-year or 5-year trade, you don't have to buy right when you think it's the bottom. Maybe add a little bit so you don't miss the opportunity to get that price. But if it goes further down, you get a better price. So I think it's almost like an art to be able to size into a position. But the key thing is accepting that patience is key, and you may not always be right. So don't go all in. And this helps me so much. If anyone that's listening is familiar with options, when you get in, the price may even be much better later on, and you're still above the entry price that you had originally bought at, but simply because of time that it's taken, it decays the value of your contract. So that's where I've learned to just slowly build in, and it helps me stay calm within the trade. It helps me know that, hey, look, if something goes even lower, I'm going to get an even better price. I'm not going all in. So for my expectations of response times, we're never going to perfect that. It's impossible if anyone tells you they know what's going to happen next. It's close to impossible. But what you can do is adapt by accepting that the uncertainty is there. You may not get the best price, so just build into your position. And I do this personally. Like I had we've seen what NVIDIA did in the short term. As you mentioned, it took a huge hit. But that was just because it was approaching all-time highs from a technical standpoint. It was either going to break it or get a huge rejection. And it was like, obviously the size of a chopstick. It was huge. Like the candle on a daily chart was quite immense, and I was quite taken back by it.
There was some issues with the Blackwell chips not like performing really well, which is supposed to do extraordinarily well as per Jensen. But all of that didn't play out really well for NVIDIA. But now it's back up. It's not as bad as it looked like in the first couple of weeks. I mean, the reason I was smiling was it reminds me of how I fill gas in my car. It's like, and uh, every day or like every other day, I feel like $10, like $20, and my wife's like, oh, "Why don't you like just fill up the tank and then don't worry about it for the next week or so? Like, why you like making this trip to the gas station every other day?" I'm like, I'm slowly building into it. Like, I'm actually like pricing it out. Like, I don't want to be buying $40 of gas at like 180 cents. I want like maybe start off at like 160 and slowly like start. I mean that's just it's just how it translates over to other aspects of your life. Nah, that's very interesting. But it's also like mean reversion comes with its own set of like cautionary aspects as well, and I feel it's very important to understand that when we talk about mean reversion, at least when we're talking about it on the podcast, we are talking more about the general markets. We're not talking about any specific stocks because I've seen a lot of investors and even like traders. They think that because the markets and the blue chip stock that's performing really badly in the short run, of course it'll revert to the mean, so it'll bounce back up. The same might not be the case with a penny stock that you're putting in like $100 worth of money into. It may never bounce back up. So uh, maybe it's also very important to understand that fundamentals still hold true. You cannot just isolate it by saying, okay, because there's this mean reversion theory, all stocks are going to bounce back up to their natural averages. That might not be the case. And there's this one article that I was reading, and I'd like to share it with the viewers here. So the hard part about regression to the mean is like there's 4 points. So it doesn't operate on a set schedule. You could be waiting, and as a result of that, you could be waiting a long time to see past average levels. Also, historical averages can become stale once more data becomes available, and the averages tend to be moving or to be a moving target over time. And obviously, we see that out in like the technical charts that we discuss. The averages keep changing as and when we get more price action data. But the second point here is so important. You could be waiting a long time to see past average levels. And I have got a chart here that talks about the 10-year treasury yields. The average, and this is from 1902 over till 2016, up until think 1950s, it was still fine. I think it was reverting to the mean as per usual. But ever since then, the market's been up. It took almost 50 years for it to come back to the averages, and it just goes on to show you that it's necessarily not the only method you should be relying on when you look to time the market, because it could. I mean, the next best rally upwards could be like a couple of days, weeks, months later from now on. So you never know. I mean, and I feel that's where analyzing the fundamentals and understanding what the general health of the company or stock that you're investing in is actually very important.
Yeah, and I just wanted.
I'm so yeah. I'll let you respond to that. There was this one, and I was looking up on reasons why the market's not been doing so well because of, I thought January would be a hit month for like stocks and stuff, and I was just curious what's changed. And obviously, there's the Trump presidency, and that's incoming. And I was like, oh, is there a conspiracy theory that because there's a new president coming in, the stock markets want to kind of come back to lower levels, and then as soon as the president takes over, the market just rallies, and it looks good on the president's portfolio because the president's now here. There's a lot of different economic factors that goes along with a new president coming in. But I was like, was it a conspiracy theory that Trump wants to show the investors that, oh, I took the markets from this level to, this level just because I'm here now, things are rosy? And there is actually a interesting phenomena in the market called the presidential transition effect, and you can trace it back to all the presidents, I think, since 1980s or so. The markets have done poor just leading up to the day that the president takes office, and 4 months or 3 months later, it's at all-time highs. So I was like, yeah, that's very strange, like a conspiracy theory.
Yeah, actually, what you said there is actually, I've heard that elsewhere from a couple of traders that do a lot of foreign exchange trading. And they take big futures positions. And one of the traders specifically, he did highlight the same thing where you reflected on the Santa Claus rally, what's happened at previous presidential elections. So I do believe that it is something you just want to wait and see and observe. And there's one expression in trading specifically that I want to mention here. There's two concepts. One is don't trade or invest in what you want to see. Trade and invest what you actually see on the markets.
Yeah.
That's number one. Because what typically happens in the trading world, and I've done this myself, is we end up manufacturing a trade. It's not actually showing the indications that we are seeing actually in the market. We're imagining, oh, I definitely, it's all down to like a bias, right? Like you think something's going to happen. You think something's going to happen. Just look at the chart. What is actually happening, right? The answer's in front of you, right? And something interesting you said also is fundamental still has a place. And I think that absolutely, I'm a technical trader because that is my competence. Like that's what I understand. I'm not a fundamental trader, not because I don't think it works. It is the most important aspect of the market aside from technical trading. Because what I'm doing is not creating a reaction to the news, but I'm reacting to what investors are doing with the news, right? I'm responding to what the market is doing. And as a trader, if we didn't have fundamental analysis, I can tell you technical analysis would be 10 times harder because it would be random, right? Like you see the FOMC minutes that occurred last week, if I'm not mistaken.
Mm-hmm.
The market priced it in, right? I was sitting there and expecting maybe something might happen, some volatility. Nothing happened because market investors priced it in or traders priced it in already. They already expected to know what was the minutes going to be about. So we are reacting to the news, not creating a reaction. And it's almost like a self-fulfilling prophecy. You see, let's say, like, as you mentioned, Trump presidency transition effect happens. Trump gets in, it's not a conspiracy. It's actually like people are waiting to see what Trump actually does.
Yeah.
Once we see those candles start coming in green, they're overcoming the previous red candles. We're seeing an all-time high get locked in at the end of a week. What is a person that's a technical trader going to do? He's going to be like, well, the market thinks the market's going to go higher. Buyers are interested. I'm going to go and hop on this train now. I'm simply going to go with the flow of money. And that's essentially what I'm doing here. And if we didn't have fundamental analysis, I don't know. I'm not really expert on that, but I need that. I need people to price in. I need people to show me a reaction. And I need those experts who can read the balance sheets to tell me what is the truth on paper. How do they actually feel about it? Have they priced it in? And then I will react to that. And the same thing applies with investing. Don't manufacture what you think the market's going to do. Wait for it to start building a bottom. Wait for it to start making a turn. You don't have to be the first one there. And then size into the position like I always do that. Yeah.
Yeah, because, even with the Trump presidency, I was thinking, I actually went back and checked if there was ever a president that came in and was like, the markets didn't do well after that. And I couldn't find any for like the last 20, 30 years. So every time a new president comes in, it's always that optimism, obviously backed up by whatever promises they've made. And you're right. I mean, it's not a conspiracy theory. It's more economics and less conspiracy theories. A lot of Trump's pro-business activities and deregulation policies that I hope come into effect eventually is good for the general business. I mean, deregulation as a whole, as a concept, is the best for businesses, not just in the US, but also neighboring countries like Canada. Obviously, the international tariffs that he's going to impose or allegedly impose, might dampen the situation a bit. But overall, I feel that the Trump presidency, like the 2016 presidency, brings in a lot of optimism for the stock market. But that brings me to very interesting point, and I've actually been thinking about this. This is obviously not a part of the conversation, planned as a part of the conversation. It's just coming up in my head right now. Is there even a point now of, you know, reading the news? I mean, obviously we need to stay updated, but does news actually help trade? Because every time I look to like trade a big, news article or like a news event, it's already priced in. It's the same thing that happened when, back in the day, Dogecoin had that whole rally, and I was like, oh, let me get in because I don't want to miss the rally, and it was already priced in with the whole the Elon Musk getting into Doge thing and all of that. And now with the presidency, already the presidency is priced in. I mean, for someone that's new to the markets, the transition time between, okay, now that the news is released to the time that it actually plays out, I feel that investors have already priced that data in even before it actually releases to the public. It's just, oh, we're expecting that the Fed would cut 25 basis points, so we're already pricing in that rate cut. So that, I mean, it's just a confirmation of what's going to happen. But overall, is there even a point of tracking news and trading the news? Obviously, I don't think trading the news is the right way. I mean, would you suggest like a novice trader to trade the news?
I think it depends. See, like what I've learned over the years is that there's a lot of unique ways to make money in the markets. And something that works for me might not work for somebody else because they have created a system, they have tested it, it works, it has a positive expected value. I find for me specifically, I always trade the reaction to the news. So if there's an FOMC meeting, I wait for Jerome Powell to say, good afternoon. And then the market does something, and I wait for some pattern to appear, some sort of sentiment that, okay, I'm not just, there's a real fine line between trading and investing where you're either actually making an informed decision or you're just gambling, right? So if you're going to leverage the news to confirm something you're visibly seeing on a chart, I think you're adding value to your position. But when it's almost like you want to predict the future, you can get into a dangerous territory there because you don't know you'll never know what insider information is. You don't know what the market makers are actually doing. You don't know what the big fish are thinking, where the flow of the money will go. So I look for breadcrumbs, right? And the breadcrumbs are simply, if you're following a line chart or if I'm following a candlestick chart, if I'm using an exponential moving average, like the 20 moving average, or if I'm looking at volume, I just want to see what is the market telling me? Because I don't know if you've seen one of those pictures where it says a big shark and around it are little fish. I'm that little fish. Most retails, if not all retail, is just that little fish. The shark are the hedge funds, the private equity, the big investors, the big banks. You want to just, so in the case with, let's say practically with NVIDIA, if you're optimistic about NVIDIA for an investment standpoint, obviously I would look at the time horizon. When am I expecting to enter this position? When I would like to hold this position? When am I looking to take a profit? And when am I looking to exit, right? And if it's like, okay, this is a stock where I believe in it long term, and if you're looking at news coming up, I would look at it and get, okay, is it approaching all-time highs? What typically happens at all-time highs? A stock might break out. But if it doesn't break out, the reaction is going to be quite like drastic because fear will kick in. Fear is the greatest motivator. That's why you'll notice that when a bear market happens, it goes down a lot faster than it does going back up. And that might be not always, because I don't know what the future is going to hold. And I've seen a lot of bullish markets come in really quick, like COVID. But just remember, you're never going to be perfect. And if you have certain levels, I think we talked about in past episodes where it was around 130, 135 for NVIDIA, looking at 140. Those whole numbers I'm a big fan of because they tell me where other people are watching the stock. And if you want to if your strategy is, okay, look, there's some big news coming out and I want to buy before it breaks all-time high. If it doesn't break all-time high, what's going to happen is it's likely to be a big fear response because people are like, what? I thought NVIDIA is going to be the next big thing after this announcement. It's not. Okay, I'm taking my shares out. And people are generally, the biggest problem that I've had in my trading was just impulse control, right? But people are so quick to press the sell button once they don't get that response that they're looking for. The news wasn't so great. They go on their Google app and some news about NVIDIA comes out saying, you know what, it was a miss. Jensen Huang was wrong. People get scared so quick and they just like, I'm out. I don't believe in the stock market. Like that's a common, is the word dogma correct? That's a common dogma. So how I would do is simply just wait for the reaction to the news. If you want to wait 1/10 of a decimal point after the highs have broken, buy it there if you want. That's what I would look at for a short-term position. But if I'm looking to invest, I actually would prefer, I don't care it's breaking all-time highs. I don't want to be there to get the big move. I want to see where that big red candle comes in and go, oh, someone's buying this. People, like, there's a common thing that I tell myself, and I'm not sure what the moral ethics around it are, but I'm buying something that's uptrending when it's in distress because I know I'm getting a better price. And that's just, for me, has been over years and years, taking a complicated system and just simplifying it to, you buy a stock, number one, that you believe in, you understand to some extent, and it's moving up. Over the long term is moving up. And you just wait for a pullback. That's it. So like, I can see a lot, like for me, when I was watching the video that day, I was looking at it for a breakout above the high of the day, the all-time highs. And when it didn't happen, I looked and drilled down to a smaller time frame and I said, oh, it's very, very drastic. Okay. Is it above or below the moving average? Across the board, it was hitting below every single moving average on the 2-minute chart, on the 5-minute chart, on the 15-minute chart, and on the 1-hour chart. Those are what I look in the intraday time frame. If people want to really drill down to seeing what's happening day to day, they want to look at those time frames. It was trending below every single moving average. And every single time it would go up a little bit, it would go further down even harder. And what that was telling me is that people are not ready for all-time highs. So either I'm going to short this, or I'm going to stay on the side and wait for my buying opportunity once the day has ended, because it was a really big candle. So I think that there is some wisdom to, okay, you're anticipating something, you're anticipating the news, but then you could be wrong. And so I'd rather just trade the reaction to the news. So a common example for day traders is FOMC, or Trump has a big announcement coming up. I would like to say never, but usually I would not press buy before the announcement, thinking what might happen. I just want to see what happens. Let me see what happens. Let me just control my impulse to do anything, observe. And if I see something that I like, I confirm something that, okay, you know what? The market has priced it in, but it seems like it's going to be a promising move up. Everything's starting to align and this looks good for the short term. Okay, I'm going to ride this wave. And that's simply it. You can apply it to trading on the short term. You can do it on the long term. You can do it on investing. But you don't want to be there being a contrarian. I think contrarian investing and contrarian trading is a very difficult skill to have. So if you are thinking, you know what, Tesla is going to go down, Elon Musk's life is over, this company is going to go to wreck, you're the opposite of 99% of the people out there thinking that Tesla has the best sales. Tesla is the best car right now, has the best operating system. Elon Musk is investing in the right areas. He's involved in the government. He's got the best handshake with the Trump administration. Why are you going to short it? Why would you don't go against the grain? You're just going to cut yourself. So go along with the trend.
If you get it right.
If right, but how quickly? Okay, like, so these contrarian investors are very good at cutting when they're wrong. They're mostly wrong, right?
Yeah.
But that one time they're right, there's a 20-to-1 trade.
Oh, yeah.
To be able to cut when you're wrong is a very difficult skill to attain. And once you get it, okay, fine. I'm wrong 50, 60% of the time. there's not a lot of people that can say that and be like, I actually stick to when I'm wrong. When I'm wrong, I cut it. So when people are investing, long story short, they don't have a stop loss typically. They're just buying something and riding the wave. So might as well buy something and ride the wave based on confirmed evidence of the market, showing you objectively, you're not making it up, it's actually going up. So if NVIDIA actually starts breaking the all-time highs, and your strategy is like, I want to just be there to break the all-time high, and then I'm going to hold this for 3 years, right? I would say, okay, well, then you're not really worried about price too much. Do you want to just wait for a correction? Then you can get a better price. It's just waiting is a very hard thing for most people. And I think playing the news before the news gets out and just assuming it, like I said, it's a very fine line between investing, trading, and gambling. And I like to stay away from it. But I also recommend everyone else heed caution when it comes to that.
What's that line? Like, don't trade the news, or trade the news, not the rumor, or something like that, right?
Well, there's also like buy the rumor, sell the news, right? Like once everyone's talking about it, you sell it. That's another expression. But it's just simply just, okay, you want to guess, or you want to wait for everybody to show you the green light, right? And you want to, like I said, you're a small fish and there are sharks. What are the sharks doing? Follow the sharks. Follow the big money. Follow the flow of money. And that's essentially what everyone is trying to do. They're trying to increase their portfolio value. So just make your life easier by doing, for example, what I do is I just follow the flow of money. I don't guess. I don't imagine. Yes, there are some strategies that I have, but they're strategies that I've actually tested that work. But if I was to just tell you that, okay, if I was most people, I would just go with the flow of money and trade the reaction to the news. Because here's the one thing, I don't know if James, you're familiar as well, but when it comes to trading any type of option contract before earnings, the price of the contracts go very high. And a lot of people, they have tried to swing trade a contract. And what they realize is even though the next day it's going in its direction, the way that they bought the contract, their contracts are losing value. That's because the contract has already priced in the move, and now the contract is coming back to the mean, reversion to the mean. So playing those type of moves is more like you're going to just lose money even if you're right. So it's better to just wait it out and then go with the flow of money afterwards. So patience, impulse control, and simply just making your life easier and you're investing simpler. I buy companies that I only know. I buy companies that I can understand the chart is moving up. I don't want to buy something downtrending. Like I think SMCI is still downtrending or maybe flattening out a little bit. Buy things. If you want to be the guy that's like, oh, I was the first one there, great. But it's really hard to make money that way, being the first one there. Same thing with all-time highs. I find that all-time highs are either going to be amazing or they're going to be a completely drastic response. You better be prepared for both. And if you don't want to be in that sort of volatility, wait for NVIDIA to hold 135. Wait for NVIDIA to hold 140. Wait for confirmation, buy it at a better price. And then you got up to 150, up to 160. Then you're going to make $20 per share. A lot more. You're going to sleep a little bit better too. So
yeah, and I feel like a lot of talks about mean reversion, they only get talked about when the markets are at all-time highs. When the market's not really performing well, and it takes a lot of courage to put money in the markets when they're not performing well, and all this kind of theories and all this goes out of the window, and like you just tend to kind of get back to the basics, right? And okay, is the company doing really well in fundamentals? Is like if NVIDIA goes to all-time lows, there is a reason behind it. So we'll have to analyze what the reason behind that is. It's not because the market's going down. It could be because of a bigger problem that's at NVIDIA or like any other company for that matter. Thank you for tuning in on another episode of Epic Market Podcast. This is James Invest.
And this is Babar Trades World. If you found value in this episode, please make sure to subscribe.